Hey everybody, Charlie Dobbins again, back here for another exciting edition of the Masterclass Group Coaching Call. And this one is I really enjoy this particular discussion because I get this conversation so often. And, it's people ask me, well, how do they come up with a cap rate? Well, the broker says the cap rate is this, but the broker says that I could buy it at this cap rate, and then once we finish doing all our renovations, then we can sell it at that cap rate. And it just burns me up all the time. All these different methodologies that these brokers use to determine cap rate. And they're not entitled to do it. It's just not how cap rates are calculated. So I came across a great third-party source that's going to help you understand how cap rates are actually calculated. So let's dig into this here. Let me just fix my screen. And obviously, as I always say, here's my disclaimer. I'm a lawyer. I'm not your lawyer. Get a lawyer. Okay, now let's talk about how do you explain cap rates. Okay, how do you explain cap rates? When someone asks you what the cap rate is in a particular marketplace for the property that you're looking at, how do you explain it? Where do you get that number from? Do you get it from what the broker told you? Do you calculate it by looking at the purchase price over the under the NOI? Now remember, the biggest lie in multifamily is the purchase price. So right away, your denominator is a made-up number. So how can we calculate a real cap rate for that particular marketplace? Now, I get this question all the time, and my answer is always very vague because obviously I deal with students all over the country. I deal with hundreds of different marketplaces. I don't know all the cap rates in a particular marketplace, and as you'll see here, there's no way for any one of us to be able to determine what the cap rate is unless we have more information. So when someone says, well, how do I know the cap rate in that particular area? My knee-jerk response has always been the cap rate is dependent upon the quality of the asset and the submarket that you are in. And you as an investor had better know what a cap rate for that particular marketplace is so that when you're analyzing deals in the market that you're looking to buy in, you are going to know whether you're buying it at the right capitalization rate or the number is way off. For instance, if you see some property that you've seen a million times and you know it trades for a particular cap rate, but then you see what they're selling it for, it makes puts it totally out of the market, then you know there's something wrong with that price because you are an astute investor and you know what the price should be for that because you understand value. So it really is going to come down to you as an individual investor to understand the formula that I'm about to show you in the marketplace that you do business in so that you can speak knowledgeably about what the cap rate is in your marketplace. So when you know that, when you are able to defend your cap rate number with analytical with great numbers behind it, no broker will be able to blow smoke and tell you that the price of the property is something that it shouldn't be because you have knowledge and knowledge is power, okay? So let's take a look exactly what I'm talking about. What happened was I received a question in an email from one of my students, and he had pulled this particular definition out of an appraisal for a multifamily property that defines how cap rates are calculated. And he sent it over and he said, can you please go through this with me and help me understand how they're coming up with this number? And I read this analysis and I tell you folks, it was brilliant. I love how they did this. I love how this appraiser has just put it down in such an objective, analytical discussion as to how cap rate is calculated. And even though I'm saying it's objective, what you'll see is that there are some numbers in here that are subjective, but you can kind of rein them in a little bit if you ask the right questions to banks and to other appraisers. So let's take a look at this right from the top. They say that capitalization rate is based on a composite overall rate developed from typical mortgage terms and the expectations of investors in this submarket. It's made up of two things: typical mortgage terms, and investor expectations. In this particular marketplace, we're just talking about a particular marketplace because cap rate's going to vary by markets. So that's what it takes. In each marketplace, the cap rate is determined by typical mortgage terms and what do we say? The expectations of investors. Okay. Well, geez, Charlie, that sounds pretty subjective, doesn't it? Well, no. Watch what happens. Watch how these banks figure this out. The likely mortgage terms are an 80% loan, a 15 to 20-year amortization. That's a little low. It's a little very conservative. We might not. This definition may involve like office buildings as well, which have a shorter amortization. But let's say it's 20 to 25-year amortization, and an interest rate of 5%, which equates to a mortgage constant of 8.59%. Now, what is that mortgage constant? That is a number that the banks use to determine the risk of a particular investment. So when they walk into their loan committee, they can sit down and say, what's the mortgage constant on this particular deal? Oh, it's an 8.59. That's pretty risky. We're looking for mortgage constants more in the 4 range. You see, the lower the mortgage constant, the less risk. The higher the number, the greater the risk. Well, how do you determine the risk in there? You determine it based upon the mortgage terms. 15 to 20-year amortization, that's a less risky loan than a 30-year amortization. So if you use a 30-year amortization to come up with a mortgage constant, that number is going to be higher. Your mortgage constant is going to be a higher number. It's a riskier deal. Okay? And the thing about this mortgage constant, this is the one variable here that you need to really pin down. You need to have a conversation with your lender about mortgage constants. What type of risk do they look at here? Now, when you're dealing with a group, a GSE, a government-sponsored entity like Fannie and Freddie, they are so big and they are so homogenous that you're going to see very little variation in their mortgage constants. Their products are all basically the same. They are, 80% LTV, 30-year amortization, no personal recourse, interest rate of 4%, boom, 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 boom. But understand what Fannie has done because they got burnt back in 2008 and they lost their shirt in certain areas. And so what did they do to protect themselves in those areas like Houston, like Michigan, like Ohio, like Florida? They called those areas pre-review markets. And so what happens in those pre-review markets? Well, their loan to value changes. It's not an 80-20 loan, it's a 65-35 loan. So their mortgage constant changed. They made that type of loan less risky because the submarket for them was too risky. You see? So banks can manipulate the mortgage constant based upon their underwriting terms. And ultimately, if you're dealing with Fred's Bank and you're going for, or you're applying for a loan at Fred's Bank, and then you're looking at the competition at Sam's Bank, well, behind the scenes, that mortgage constant is a competitive advantage or disadvantage based upon the underwriting guidelines of the bank. One bank may look at your deal and say, that's the kind of deal we want to get into. So their risk factor will be lower, their mortgage constant will be lower versus another bank that looks at your property and says, we don't like multifamily, we got burnt in multifamily, we don't want to do multifamily again, our mortgage constant is going to be higher. So that bank takes on risk dependent upon what their competitive advantage or experience has been, and that's how they determine whether they're going to get into the deal. Okay, so that's the mortgage constant component of this equation. That's now an equity requirement of 11% is generally required by astute investors for a property of this type situated within a viable commercial corridor. Okay, what does that mean? That means that for you to raise private money, they believe that astute investors will put money into your deal if you are going to give them an 11% return. So that's another question I get all the time. Hey, how much money should I offer my investors? I don't know. What will an astute investor want in this particular marketplace? You should know. Remember how you hear me talking about understanding the flavor of your investor's money? That's what we're talking about here. What this particular analysis is saying is that 11% is the flavor of the money for an astute investor in this particular marketplace for this particular deal. Okay, so now look at this analysis below. What you're seeing below here is what we call the capital stack. The capital stack is all the different places you're getting your money from. You're getting your money from the bank. That's debt. That's part of the capital stack. Then you're getting your money, your down payment from your investors. That's part of the capital stack. That's the equity component. Can you have different levels of equity in there? Absolutely. Some people's money might be more valuable than someone else's money. So in that particular case, you're going to have multiple levels of capital stack. So in this particular case, what we're doing here is we're adding up the capital stacks so that it equals 100%. And remember, we already know that the loan to value is 80-20, so that means 80% of the capital stack is going to be the banks, and the other 20% are going to be those 11% investors. So how much does that money cost us? And when we add them all together, what is the capitalization rate for the funds that we need in order to buy this property? Now, the reason why we do this is we want to understand the cost of the money, because everybody wants to know, hey, what are we getting here? Is this a good deal or is this not a good deal? Remember, we want to value this multifamily deal in some way that it is able to be compared to other investments. And when we look at the cost of money this way, then we know, geez, are we better off being in this type of deal, or should we get better terms, or should we go somewhere else for a different deal? Because we don't like this cap rate. This cap rate is too risky or is too expensive. And this is how we do the analysis. So see what they do. They take the first capital stack, which is the debt, the mortgage. This bank has a mortgage constant of 8.59, and we multiply it by 80% because 80% of the money is going to be that 8.59 valuation. So that comes out with a number of 6.87. The remaining 20% comes from people that are costing us 11% on our money. So we take that 11% times the 20%, and it comes up with 2.2. You add those two numbers together, 80 plus 20 equals 100, 6.87 plus the 2.2, and you come out with a composite cap rate of 9.07. And so the cap rate on this particular deal is 9.07. Now, let me show you how these numbers change. What would happen if instead of it being an 80-20 loan, it was a 90-10 loan? So we go, now realize something here, that when we go from an 80-20 loan to a 90-10 loan, is that a more conservative loan from the bank or a riskier loan? It's a riskier loan. So shouldn't the cap rate go up because there's more risk involved? Well, if we look at this particular number here, we take the 80% and change it to 90. And then we take the 11% and we multiply it by 0.1. If you redo those calculations, what you'll find is that the cap rate goes down. Now, don't get excited here, folks. Don't think you're going to run out and try to explain to a bank, that doing a 90-10 loan is a lot less risky than an 80-20. No, because remember, what the bank then looks at is their risk on the deal. And if they see that they're doing a 90-10 loan versus an 80-20, their mortgage constant is going to change because it's now a riskier loan within the confines of the bank. So the bank is going to say, oh, no, that doesn't qualify for a 8.59 mortgage constant. This is more like a 9.3 mortgage constant now. Now go back and recalculate your numbers. And then you're going to see, yeah, you know what? This is definitely a riskier deal, and the cap rate should be higher, and it is by changing that mortgage constant. So the bank will determine the mortgage constant based upon the risk involved. If we drop it down to a 70-30, the mortgage constant is going to come down. It's less risk for the bank. Okay? Same thing with the length of the amortization. A 20-year amortization is less risky than a 30-year amortization. That's going to impact the mortgage constant. So do you see how these numbers all tie in and how they all come together and fit It's really so. You might think to yourself, well, Charlie, how can I figure this out based upon the marketplace that I work in? Well, you know what? You really do have to have some discussions with banks, but at the same time, taking this type of analysis and backing into seeing deals that you've seen sell in that marketplace, you're going to be able to figure out what a typical mortgage constant is in that marketplace, and then you will be able to back into what the right cap rate is for a particular deal. Let me just go a little bit further here and show the other part of the other part of how they came up with a particular number. So as noted within the previous report, this happened to be a Columbia, South Carolina deal. The sales from the Columbia market offered abstract rates, cap rates of 6.81, 8.04, and 7.93. The most current overall capitalization rate market data for the national apartment sector from the PricewaterhouseCoopers Real Estate Investors Survey, first quarter 2015, folks, you should probably go there and find that report online, indicates an average cap rate in the Columbia market of 5.36%. And that ranges anywhere from 3.5, which is probably a brand new property, all the way up to 8 cap. So that gives you the range and the average there for what's going on in the Columbia, South Carolina marketplace. Finally, a band of investment, the capital stack, that's another way of speaking of capital stack, is calculated to indicate an overall rate as follows. On a 75 loan to value, the mortgage constant is comes out with this number, 25% equity portion at 5%. Now, where did that 5% come from? Where did that 5% come from? That's not the interest rate. We quoted in the previous slide, they used 5% interest rate as a mortgage term to help calculate out what the mortgage constant was. But where are we coming up with this 5% right here? The answer is, that is what an astute investor is looking to earn on his money in that commercial corridor. Okay? So that 5% is what an investor is looking for. And that's how you come up with the second portion of the capital stack. And then you take an overall capitalization rate. You might be looking at this like, wait, how did this guy round up? Well, he rounded up to the nearest quarter level. So they come up with an overall capitalization rate on that type of a loan at 7.75%. Okay? So do you see how that came up? Even though the average rate of 5.36 was what we were seeing in Columbia with ranges from 3.5 to 8, when we took into consideration the bank and the equity stack, the equity component, we're looking at average cap rates in that particular marketplace of 7.75. That's how the number is calculated. All right, so don't go running back into the PricewaterhouseCoopers survey and just grab that number 3.5 to 8. You have to take into consideration what type of a capital stack you're going to be building on your deals, and that's going to determine. So now you know, and you have it. You've done the numbers. You've done numbers that the brokers won't even know how to do. You've done that, and you've come up with a cap rate of 7.75%. Then you take that information and you go right over to the broker and say, this property should be trading at a 7.75 cap. I've calculated out the NOI to be this. The price is that. Well, where'd you come up with that number? Hey, where did you come up with your number? I'll show you mine if you show me yours. And that guy won't be able to show it to you because the brokers do not do these types of calculations. Okay, that is it. That is the discussion on understanding cap rates and how to calculate them. Type in a question down the bottom. I'll get back to you as soon as I can. But this should give you a much better understanding of how you need to understand cap rates so that you can run circles around the brokers and what their numbers are. Okay? All right, everybody. Hey, hope this was helpful, and you know how to get a hold of me. I'll talk to you all soon. Thanks, everybody.